started on time. Hello, everyone, and welcome to our Simple Steps to Planning Your Transition series. My name is Brittany Bowling, and I work for Vision One High Performance Leadership Group, and I get to help put on wonderful events like this, bringing together experts for you to be able to learn more about transition, growing the value of your company, and building strong leaders. We are getting towards the end of our series. Our main objectives here are to help you understand the integrated transition planning process, to learn the importance of your transition planning team, and to be able to walk away with free tools and resources to help you along your journey. Now, during this time, we have met with people from banking, community impact, legal, business brokering, and today we are so pleased to be able to have a conversation around your CPA. And next week we will finish up with wealth management, and you won't want to miss it. As I said, today we are on week 5, and with that, I would love to turn it over to our expert, Senior Transition Planning Advisor, Lori Moen.
Thanks, Brittany. Good morning. My name is Lori Moen, and I like to introduce myself as a former trophy wife, and I can say that because I'm a recently exited business owner. I sold my trophy and awards business in May of 2019. Therefore, a former trophy wife. But just to give you a little background on myself and why I'm here today and why I'm passionate about this subject is after 25 years of being in media, radio, advertising agency work, I became a corporate refugee, as it's called, and recreated myself. And I bought a trophy shop. I bought a business in 2003 from the original founder. It's called Viking Trophies up in the northwest suburbs in Brooklyn Park. And the founder had started it in '69. He was tired of running the business and was looking to sell it. I was tired of working in corporate media and wanted to try my hand at something else. And I became a trophy wife and a small business owner. It was phenomenal. 12 employees, awesome business. I mean, who doesn't like celebrating the positive achievements for people? And that's what we did. Now, I bought that business as a lifestyle business, as a job, as a way to not get fired again, and as a financial asset for my family. I knew I would be selling that business at some point in time. So I learned that industry, kept that business chugging along, grew it, and realized right around 2015, 2016, I needed to grow its value. Because if I wanted to sell this business, I needed it to be a valuable business so I could sell it. And that's when I started working actively on my transition, on building the value of the company so I could be ready to exit, which I did successfully in 2019. I sold it to my then general manager. And it was a process. It was a process and a lot of struggles. I didn't just wake up one day and say, I'm going to sell my business. I had to get it ready. I had to work with my advisors to make sure I was making the right decisions. That when I transitioned out of that business, I had something else to go to. And that's why I'm doing what I do now. As a certified exit planning advisor and a certified business coach, I walk alongside business owners with Vision One High Performance Group, helping business owners work on their business and bring transition planning to the present tense. Because if you look at transition planning, it's really a three-pronged approach, if you will. It's a process and it's a business strategy. It's not something we at Vision One feel you should just wait until right before you're going to transition, because you lose a lot of opportunities with that mindset. It's value growth. It's growing the value of this asset. And while you own the asset of your company and you grow its value, you as the owner reap those benefits. It's also succession planning. You know, what does that next step look like? Is it internal? Is it family? Do you need to grow that next generation of leadership? And it's exit strategy. You know, what are your own objectives? If 80% of your personal wealth is tied up in your business, what does that mean? What does that mean that transition needs to look like? So once you no longer have that income flowing through your personal estate, what do? How do you plan for that? So today we're talking about those. It's the fact that it's a 3-step process and it's a ever-moving process. It's not something that's one and done. You know, we look at it as a circle, as a wheel, if you will, that you as the business owner are working through regularly. And at step 1, you identify your goals. You know, what does transition mean to you? What does your future mean? As a business owner, every decision you make now affects your business and will affect that ending point. But what we're focusing on and have been focusing on for these 6 weeks is building that transition advisory team. You are an expert at running your business. So we challenge you to bring along other experts to walk alongside you, build your team, so you can make sure your transition is successful and you maximize that transition. And there are people that need to sit in those seats in order for that transition to be ultimately successful. And really a step, when you look at your transition and you look at it today, it's a funnel. And it is part of your business strategy. And if you look at the world today and you look at the baby boomer business owners, there's a lot of us. And there's a whole lot of them that have no plan. Less than 24% have an exit transition plan. That's frightening. And when you attempt to go to market or you attempt to transition without a plan, you know what? You have a high likelihood of that transition, that sale, that process, that being rejected, and it becomes a failed transaction. And what we want you to do is to be successful from start to finish. And there's a lot of simple steps, a lot of things to be thinking about now. And that's where we feel it is a business strategy that you want to start early. Don't wait till the last second. Look at your mindset. Have an ownership mindset. And you need to communicate and understand the process. And that's what bringing other people, other advisors onto your transition team can do for you, is they can help you understand the process, because it is a process that takes time. Depending on your business and how you've worked on your business versus just in your business, that makes a difference. Your team will provide that expertise. They'll challenge you. They'll ask you questions. They'll ask you the key questions and help you find the answers. So when you come through your transition, it's successful. Because really, we feel the transition itself is a 3-legged stool. And all 3 legs of that stool need to be solid foundationally and even, so it doesn't wobble. So your business leg is solid. Your financial leg is solid. And oh, by the way, don't forget your personal leg. What does life look like after you transition? So you've got 3 things, 3 pillars to really look at, and you're running your business at the same time. And that's why having people surrounded yourself with professionals can be so helpful. Because over the course of your business ownership, you are getting your business ready and you're getting yourself ready. So when we look at transition planning holistically, and we look at building your advisory team, there's a number of people that will sit at that table with you. Now, they may come in and out. They may walk alongside you the whole time, but it's about gathering those people that are transition focused, that understand transition, and can help you fill those gaps. So they will be your financial advisor, personal, your wealth manager. It'll be a CPA. It'll be a tax advisor. It'll be a CPA that has a transition mindset. You'll bring a valuation professional on board or a broker for a period of time. Your attorney will have some questions for you as you look at the whole process. Transition planning is not just estate planning. It's more holistic and it's bigger than that. So that's how we are approaching this, and that's how we're getting started. So I challenge you to think for a minute and put them in the chat box, because that's the format that we'll be using for asking questions. You know, what are the top 3 problems you think you can anticipate for your own transition planning process? Because right now, today, we're talking about the CPA. How would you rate your relationship with your CPA? Choose one of the boxes on this poll. I don't have one. I only reach out when absolutely necessary. I have a good relationship. I have an excellent relationship. Take a minute and submit how you would rate your relationship with your CPA. And Brittany, when we have the submissions, you let me know.
I will. And throughout the course of today, if you have any questions, please type them in the chat box or in the Q&A. I'll be watching those. We want to make sure that any questions that you have, you walk away with answers today. So 75% said they have an excellent relationship. 25% says I only reach out to them when I absolutely need to.
Okay. Thank you. Thanks for participating. Now, let's move on. I am thrilled to introduce you to Ryan Stretmater. Ryan is a forensic accounting and valuation services expert. He's with SDK, and he sits in our chair today as our expert presenter wearing the CPA hat. Now, Ryan and I both have thoughts and things and comments we want to get across today. We have our agenda, but remember, we're here to serve you. So if at any time we're missing something or you have a burning question that we're not covering, just let us know and we will answer it. So Ryan, the floor is yours. Tell us a little bit about yourself and why you're joining us here today.
Will do. Thank you very much. I'm excited to be here. The first 2 thoughts that come to mind are that I've aged over the last 4 or 5 years, which is where my picture comes from there. Also, I fall into the category of having an excellent relationship with CPA because I consider myself my own CPA and I like myself. So yeah, a little bit about me. Ryan Stretmater. I grew up in the auditing world. And after digging like crazy and blowing up budgets like crazy, I decided I needed to do something else. Because I really enjoyed getting into the financial records to see what's really going on. So my first foray into consulting was in the due diligence arena. And I became a certified fraud examiner and also certified in financial forensics through the AICPA. I worked on fraud investigations. I work on litigation assignments. I've also worked on post-close disputes. And given my broad knowledge and experience, I started getting more involved in more business coaching or advising of business owners. And I guess that's what brings me to the table today.
Mm-hmm. You bring up some interesting things that I just noted and I'm curious to learn more about them. Of course, those 2 words that bring a shiver into a business owner's world when they're getting ready to sell, due diligence. So it'll be good for you to talk a little bit about that process. And post-close disputes. There's post-close disputes. I'm so surprised. So those are a couple areas that I would like you to highlight over the course of the next time we're spending together. But go ahead.
Yeah, no problem. The way I look at it in a cynical way is you can pay for me now or you can pay for me later. So let's do it up front if possible and avoid those.
Absolutely, absolutely.
Yeah, so the way I'd like to start would just be with some transition statistics. I suppose most of you are familiar with these, but I just want to call out the disconnect of everybody agrees that having a transition strategy is critical.
Yep.
Most of the business owners have their financial assets tied up in the business.
Mm-hmm. Mm-hmm.
48% have done no planning, and yet half say they want to transition in 5 years or less.
Well, I don't need to plan. That's not going to happen for 10, 15 years from now.
That's right. And my pet peeve is when I'm talking with an owner, whether they're considering or not at the time, and they say, you know what, I don't really need to worry about it right now because I'm probably not going to sell for a year or two.
Yes, I
And
know.
I want to shake them and say, you're already behind the eight ball. I mean, this is a long process, and
Yeah.
to do it correctly,
Mm-hmm.
start early.
Mm-hmm. And you know, it's funny. Well, it's not funny, but I mean, I experienced that as a business owner because I'm thinking, okay, I'm going to get ready to sell. And then it was like, wow. I mean, it took us a couple years. It took me a couple years to get there. And you know, I will say while I was working on it and when I was making the business not as dependent on me by stepping out of the day to day and having the general manager run the day to day, we had some of our best years ever. So, I mean, it took time. I got to enjoy the fruits of those labors, but yeah, it took time and focus.
That's right. All right. So why is there this disconnect then? Everyone admits that it's there, but well, we have reasons for lack of planning, right? And those, the main ones I've got up on the screen here. I mean, the big one is that it just requires really difficult decisions. And this is a big part of their life. And at the end of the day, the vast majority of business owners say that their business provides a sense of purpose. And how do you get around that if you need to? It shifts focus from the business operations. Clearly, there's privacy concerns, and this could be business and personal, family issues come up, and that's a big issue. Cost. I mentioned earlier that you know, you can pay for me now or you can pay for me later. The way we look at it is that this is such a substantial portion of your financial well-being that if there's ever a place to not skimp on costs, this is it. Do it right. In the world of post-close disputes, we see things come across my desk and I go through it, and you know, inevitably one of the first questions I ask is, you know, who were your advisors? Who helped draft this agreement? You know, I mean, how did you get here? This doesn't make any sense to me. Again, in a cynical way, I look at my own experience doing so much in the post-close arena is that I don't necessarily know how to structure a good agreement, but I know how to structure a bad agreement because I've seen all of those pitfalls over and over again.
Sure.
Then obviously there's this belief that planning equals retirement. There's many, many, many different ways. And the way that we usually approach the business owner is we're talking about transition of ownership that many experts believe, and some business owners believe as well, that a lack of transition plan could be the riskiest issue in your business.
Sure.
So if you really want to stay on in management, you really enjoy it, no one is saying that because you have to transition your ownership, you have to go away and ride off into the sunset. There's different ways to do this. And that's why your advisor team is so important to help you walk through your options. And again,
sorry.
Go ahead.
You know, I was going to say on the cost factor and putting on my business owner hat, you do have to gulp and dig deep sometimes to make that investment in the planning process and in using your advisors, you know, because sometimes as a business owner, you can see it, it's just an expense and I don't need that expense and I can do it myself. And I look back at some of the mistakes I made as I was getting ready to sell. And I was penny wise and dollar foolish, you know, thinking I don't need to run this by my accountant. I don't need to run this by my attorney. And those are choices you can make, but they do have consequences.
Right.
So.
And it's incredibly difficult to run any sort of an ROI on these types of advisor expenses.
Mm-hmm.
It's there, but it's very difficult to quantify. I equate a lot of what we do with business transitions to selling your home. You know, if I upgrade my appliances, I redo my bathroom, what's my ROI? What am I selling? How much more can I sell my house for? You're not able to quantify that, but you just know that when the buyer looks at the house, they're willing to pay more. You know,
And I would challenge a business owner to take that. I love that analogy, and I'll use it and say, and do those things now so you can enjoy it.
That's right.
You know, don't wait until 2 days before you want to sell the house to redo the kitchen. You don't get to enjoy it. You know, that's where, you know, when I say in the 2 years of really focused work for getting the business ready to sell, we had our best years ever, meaning gross profit margin, cash flow was dramatically better. You know, I got to enjoy those elements as a business owner. So yeah, it's like getting your house ready, enjoy it. Do it so you can enjoy it as well.
Yep. So homes, cars, and businesses are usually in their best condition the day of purchase and the day of sale.
Yep.
Right?
Yep.
So why not enjoy it
Absolutely.
throughout the whole time?
Yep.
And then again, just to finish up the slide, there's obviously a perceived lack of available assistance. But again, obviously that's not the case. There are lots of advisors who are willing to help, and that's what Vision One is showing you through this series.
Now, Ryan, you know, when I look at, there are lots of advisors, there's a lot of assistance available, but in your opinion, I mean, you've got, you know, you do have a lens that you're looking through that's perhaps different than a traditional CPA that isn't exposed on the transition side. Wouldn't you agree?
Yes.
So, I mean, there are experts that have a transition lens.
Absolutely. Absolutely. And there's, just like there's lots of different facets to law, there's lots of different facets to accounting. So you may need more than one expert or advisor, I should say, in the world of accounting. But the help is there. And if you're able to reach out to people, usually somebody knows somebody who's really good. And if someone reaches out to me and says, hey, do you know an attorney? Do you know an investment banker? I don't just say, oh, you have to use this person. I usually say, well, here are the 2 or 3 we've had success with and worked well with in the past. And here's the characteristics that I think would be valuable to you. And let them make their own decision. Sure. The way we look at it is we're not trying to be the smartest person in the room. We're trying to advise them and really look at the business owners from their point of view. And you know, we always, you know, I was taught at a very young age in my accounting background that the worst thing you can say to a client is, look, I have lots of other clients. You know, you're not my only client. That's why I couldn't get to this, right? Yeah. And if the business owner you're working with really feels that you're on their team and that they are my only client, that's where you need to be.
Sure, sure. You know, and I would also remind, you know, all of us, keep in mind for business owners, you will, it's foregone conclusion, you will transition from your business. And you will either do that vertically with a plan, with choices that you've made, or it will happen horizontally. So that's the idea of let's plan your transition and have it be part of your thought process now.
Yeah, that's right. I mean, change is inevitable. Your business will transition either voluntarily or involuntarily. So why not do it on your terms?
Exactly.
I mean, the consequences of not doing it, I'm an accountant. So the very first one is, you know, your options come off the table. You could mean less money. The lack of the interim contingency plan, again, your business will transition. voluntarily or involuntarily. Unrealistic valuation expectation is obviously something near and dear to my heart. We talk to business owners all the time that say, I expect to sell my business for between X and Y. My next logical question is, have you ever had a business valuation done? Half the time it's no.
Yeah.
Well, then how could you possibly have an expectation? You need to be able to maximize value. I mean, you talked about it, Lori, that it took some time. And once you were able to jump into it and say, well, now I'm going to start to transition, I'm able to maximize value. And most business owners think about their business as a means of income, not a means of generating value. And the sooner you can get behind that concept, the better. And then the timing expectations are not met. I gave you the example of someone saying, well, I don't need to sell for another year or two.
Sure.
Look, you're going to cram everything in. Mistakes are made when you're up against a deadline, and that's where the risk happens. So,
well, and you want to be ready for when an opportunity arises as well, so you can take advantage of it and not have to pass on an opportunity. I mean, I learned that when I was working on getting Viking trophies ready to sell. I had there, and we'll talk about this, there's lots of different kinds of transitions. I was thinking I would be working with a strategic buyer, and I had made a list of companies that I thought could grow by acquiring me, that I would be able to fit into their product line, and had early conversations just to share that idea with some potential strategic acquirers of how it could work. And that's where my head was at. That's what I was thinking. That's who I had identified would be the person or the kind of purchaser. Well, then my general manager came in and he resigned because he wanted to start his own awards and recognition business. Well, that gave me a little bit of a pause. And I said to him, why? Why not just buy this one? And that caused us both to step back and regroup. But I hadn't thought of that. I hadn't thought of that kind of buyer. I hadn't had that conversation. My timing expectations were different. I had thought the transition would happen later, and all of a sudden this was presenting itself sooner. But because I had been working on it and had it in process, I was able to step up to the plate for a new timing expectation that maybe I hadn't scripted out for my plan.
Yeah, and nothing is going to go according to plan, right?
No.
All right, well, we've gone through the statistics and the reasons why people don't plan even though they should, and the consequences therefore. But the good news is for you business owners out there, if you're already watching this video, you're probably ahead of the game and you're at least on board, right? So what we need to figure out now is your business actually transferable? Are you replaceable? Are you too vital to the business? Because if you're too vital, transition is going to be very difficult, at least at a value that you would desire. A couple things I like to bring up are, do you have all of the customer relationships on a personal level? Will they stick around? Are you transparent with the business, with the other members of management? Are they able to take over? Or does everything leave with you? Lori, you talked earlier about, your lifestyle, that's why you got into the business. Are you do you really have a company, or is it just a lifestyle? And, a prospective buyer isn't going to pay for your lifestyle. They want a company that's going to have a return on investment for themselves. And then expectations versus reality. We talked about lots of this already with business valuation, timing, etc. So if you say, well, I need X number of dollars to retire, and so that's what I'm selling my business for. I mean, no one is going to invest in your company solely for the purpose of giving you the money you need to retire.
Right.
They need their return on investment. And what I like to ask the business owners is take a step back, really think about it. Would you invest in your company right now from scratch?
That's a great perspective to put out there, to have, in the forefront, to challenge that owner to look through the lens of the purchaser.
That's right.
Lens of the buyer. And because, as an owner, our businesses are our babies, and they are gorgeous. They are the best looking babies around. And wouldn't you like to pay a lot for this baby? It's so beautiful. Well, that's through our lens as a business owner. And it's interesting because when I think back and when I hear you talk about these elements, and I remember back in 2003 when I was buying the company, I was probably a seller's dream client because I got a little bit emotionally attached to making this purchase. And okay, maybe I didn't look in the cupboards quite deeply enough, and really delve into some of the specifics. My due diligence as a buyer was perhaps a little light. But then when I became the seller, I challenged myself to remember that so I could, make sure all the nooks and crannies were taken care of. And like you said, it was in its best possible condition.
Mm-hmm. Yeah, and continuing on the expectations versus reality, it doesn't have to be timing or business valuation. It could be the expected succession plan. We hear stories about somebody who says, well, I'm going to pass the business on to the next in command. And similar to what you talked about, Lori, these individuals may not want that. And we've heard instances where someone has said over and over and over again, I'm going to transition my business to the next in command. And we ask, well, do they know? And usually the answer is yes, but sometimes they don't. They've never broached that subject where they say, well, I don't want to scare them into thinking that I'm leaving. And look, these are difficult conversations. We talked about that. That's one of the reasons of lack of planning. But these are difficult conversations that need to be had. And if you're serious about transitioning the business down to the next level, then you need to have those conversations.
And the same goes with family members. When I bought the awards shop, it was because the owner had discovered that family members, sons and daughters, weren't interested in taking over the business. And so you may think you have a plan in mind, but it goes back to communicating, having those hard conversations to find out, what you have in your head, is that what the people around you are thinking the same thing?
That's right.
Yep. Mm-hmm.
All right. So now let's assume that your business is transferable for this hypothetical purpose. So what drives the sale? Many of you are aware of these items. We've got stage of the company. The early stage growth is more desirable for a buyer than a very mature company. Business valuation clearly is going to affect the sale. Again, in the post-close environment, since I know you said you want me to address that to some extent, a lot of the disputes that we see are related to contingent purchase price. And this could be by way of earnouts, or it could be a percentage of profits for the next year, whatever it may be. We like to tell people to stay away from earnouts as much as possible, or any sort of contingent purchase price. Earnouts do have their place in very binary environments. I like to think of, in a pharmaceutical company, if there's a a date that a drug gets approved, and that's very binary, yes or no. Okay, well then an additional payment can happen. The problem is accounting is not an exact science. There is an art to it. It's not black and white. I once had a partner tell me very early in my career that cash is cash and everything else is just a journal entry. So anyway, so clearly price is going to affect the sale, but too often we see parties jump to, okay, well, we'll worry about that later. So we'll figure out a price now, and then we'll do some sort of contingent piece going forward. And the truth is, if you can't agree about it now when both parties are really motivated, it's going to be difficult to agree later when there's a dispute.
Sure, sure.
Obviously, conditions in the industry, is it a growing industry, and what's the trend in M&A? We're in different times now in 2020. I know that M&A pretty much went to a halt for a lot of people, but it's coming back, and there's certainly desire to pent up energy to get back out there.
And it's interesting you bring that up. I mean, the current conditions, those external forces that you don't necessarily have control over, changes things. I mean, and you may have had, as a business owner, you may have had a mindset of when your transition was going to happen. And then all of a sudden, 2020 happened. And now you're looking at your business because it's changed a lot. 2020 perhaps did not go the way you had planned. And to be able to now get back in and realize your transition plan may have changed. The timing, because of the conditions, may have changed. You may need to take a step back and really focus on growing the value of your company, because it may have taken a hit. And on the flip side, 2020 may have been a boom to your business, as it has been for some. And that requires taking a step back as well, because the world's different. So those conditions, are really big forces that you can't necessarily control, but you need to be aware of.
That's right. So just to stick on the valuation component here, the factors that increase value, at least from what we see from an accounting standpoint, products that are proprietary, diversified, again, early in their lifestyle are more desirable. That will increase value. A diversified customer base along the same lines. Financial ratios are either at or preferably above industry average. So we ask business owners, have you done any sort of benchmarking, with industry publications, or have you reached out to experts who have tools to understand what the statistics are within your industry? And then also, is there deferred maintenance? So if there's no major investment needed by the buyer, then that would, in theory, increase value as well.
Got it. Talk a little bit about those benchmarks. Have you worked with your clients to help them develop some benchmarks or some key performance indicators to, have some a report card, if you will?
Yeah, absolutely. We use primarily RMA statistics that go down to tax code for your business, and so it'll be along similar lines. And it could be very specific, could be very general. It could be just gross profit percentage. It could be EBITDA, or it could be much more detailed. Think of like a trucking company. Over road miles, fuel costs, that type of a thing. So it could be very, very specific as well.
Sure. Got it. Interesting.
All right. Well, going on to the options that you may have. I think the default for many people is, well, if I'm transitioning my business, that means I'm selling 100% and I'm riding off into the sunset. I know, Lori, you have information on this later, and you can talk about it in a little more detail, but the point is, it's important, and it can be talked about twice, to understand that you have options. You can do a sale, merger. There's recap opportunities if you just want to cash out a little bit, and you can have investors. We talked earlier about income versus value. Again, business owners tend to think about their business as an income stream to themselves when you really should be focusing on growing value. Is this retirement, or is this just a process of getting out of the business? And then what will your role be in the transitional environment? Are you going to stay on as a consultant? Are you willing to do that? Do you want to ride off into the sunset, but the buyer wants you to stick around for a while? What are you willing to do? And this can all play into your desire to exit the business. If you say, well, I want to be 100% done, retired, move out of the country in 5 years, well, you may need to sell or transition in 3 and then or 4 and have a year or 2 transitional environment with the buyer to help them along. So things to consider.
Absolutely. Well, and it brings to light the fact that this process is not just about getting the price. It's about the terms. It's about all the fine print after you've agreed upon a price. You know, it's all of these other elements that will determine how successful your transition and the transaction is.
That's right. All right, I'll go over this relatively quickly, just how to prepare for a sale. You know, I mean, when do you start the process? Now, how about that, right? You know, if you want to grow value. And the first step you take is the best step. Any step you take is a good one. So it could be getting a business valuation just so you understand where you are now. And then when you want to sell in 10 or 15 years, you can figure out where you are then. You know, why are we here today? We're talking about assembling your team, right? You know, investment bankers, attorneys, accountants. We talked about how, you know, as much as I am a CPA and I consider myself good at what I do, there's certain areas of accounting that are not my forte. The biggest example would be in tax due diligence. We have separate members of our team who specialize in that. So we usually pass those aspects on. And then obviously you need to review your documentation. You know, do you have signed contracts? With equity ownership, it's pretty amazing. There are times where we get involved and the equity documents don't match what's on the financial statements or other records. And the owners have no idea why that is. And these are clearly things you need to figure out right away. This is not something that you want to be a surprise at the end. And then if you happen to have any, you know, verbal deals, make sure you get those finalized because that can take some time as well. And the longer you can extend contracts and deals, the better. Multi-year agreements, for example, are better than, you know, as you go.
Right. Because that person or that entity that's buying the business, they're buying the future growth. You know, you can show your historical and that's great, but their mindset is, what does the future mean? And so, like to your point, if you have agreements with clients, if you have pricing agreements from your vendors, you know, to be able to show that those are in place going forward, that makes that business less risky. And you mentioned having, you know, the difference in CPAs and CPA world, you know, someone that's a tax focused versus forensic or transition focused. You know, that's a great reminder because as business owners, oftentimes we are challenging our CPAs to help us minimize our tax bill every year. And that's what we're all about. You know, how can we pay the least amount of taxes? And if you're S Corp, it's coming through you personally. Where when you're selling it, you have to change that mindset. It's about showing and demonstrating through your financials how much cash this business throws off so that new owner can, you know, pay their debt if they're taking on debt. You know, if it's a smaller business and they're getting funding from the SBA to demonstrate they can make those payments. So, you know, it really does require 2 different ways of looking at the business, like you mentioned.
Yeah, the CPA industry has really been evolving in recent years from a traditional compliance to more of a consulting advisory. And I started my career over 20 years ago, and we always, from day one, considered ourselves to be trusted advisors. And, even if a client had a plumbing issue at home, we wanted them to call us first, right? And say, hey, do you know a good plumber? But it was really hard to be in that position if you're just doing tax work. But the base of knowledge has really increased for CPAs over time, and it's gotten much more specialized. It's gotten broad and more specialized at the same time. But the thought of 25 years ago being a business advisor as a CPA, that was a little foreign to me and others. It was, no, you either went into audit, tax, or you maybe went into this niche group of valuations or something. But you kind of stuck in your lane and that was it. And that's just not the way it works anymore.
So walk us through when a business owner is preparing for a sale, what is the role of the CPA? How can a business owner maximize their relationship?
Well, how much time do we have? So
you're fine. Don't worry about it.
Okay. So, at the end of the day, primarily it comes down to financial reporting, and we want to eliminate surprises.
Okay.
And we can help with that. So, again, a significant portion of my work that comes across my desk relates to post-close disputes. And good financial reporting can usually mitigate some of that risk.
So what's good financial reporting?
Well, the first two bullets here would be consistency and reliability. Okay. What I tell a lot of people is that in purchase agreements, there used to be a clause that would say, seller agrees that the financial statements are reported on a GAAP basis. Then over time, it somewhat transitioned to GAAP basis consistently applied. And then that was a bit ambiguous even. So now most agreements say GAAP basis consistently applied throughout all periods. And we're trying to get more specific. So consistency, you may think that you are consistently applying your accounting methodologies, when in reality, you're doing it at year end every year, and that's it. So that's great if you happen to have a close date on December 31st of every year and you've made all those adjustments as of that day. But usually we'll see things, every year we put on our prepaid expenses, we accrue for vacation, we adjust our deferred liability. But then there's a close date of June 21st and none of that's been recorded. And the purchaser finds that out after the fact and they say, well, we're finding all this other stuff. And the seller says, well, but it's consistent with what we've always done. And then there's a disagreement that says, well, no, you say that it's according to GAAP and it clearly isn't because you haven't recorded all of these transactions. So that's where we see a lot. Obviously, it needs to be reliable. The way that we tell business owners and CFOs the way to clean up your financial statements are, make sure your income's all being recorded. Make sure your financial statements agree with the tax returns. That often doesn't happen, or at least if there should be a reconciliation prepared contemporaneously as to why that's not happening. This seller discretionary expenses, remove all the personal items out of there. That's always a good way to de-risk the business for the buyer. The allowances, whether it's allowance for bad debts or it's an inventory obsolescence issue. We talked about prepaid expenses, making sure those are on there. Related parties are always a scary topic. If you do have transactions with related parties, make sure you're abundantly clear about all of those issues. Make sure they're at market value. And if they're not, then start making the adjustments now, because this is when someone comes in to do due diligence or a buyer comes in, they're going to look for what I call risk-based auditing. Where are the biggest issues? And related parties and estimates are going to be a big one. If you happen to have, I just briefly talked about the obsolescence issue with inventory. If you have old stuff, it's damaged, just get rid of it. Remove it from the books. Same thing with property and equipment, fixed assets. Fully depreciated, if they're damaged, you don't have them anymore. Now's the time to go through the list and just get rid of it. And then just make sure you've got all your liabilities recorded. I talked about accrued vacation. There's other items, and we as accountants can really help you determine which accruals would be necessary to record at any point in time and how best to do it, whether it's monthly, quarterly, etc.
Sure, sure.
And then that's more from the financial reporting side. Obviously, we have the taxation side as well, making sure that your returns are filed. Everyone needs to understand if there's any issues with taxing authorities. Sometimes a seller may say, I've gotten these notices from California that say I need to file out there, but it's a non-issue, because we don't do business out there, so I don't have to do that. Well, you do need to be upfront about this, because if these issues come up during the transition process with a potential buyer, it just raises red flags. And again, I'll probably do it again, but I'm going to equate this to buying a house. If you're walking through a house at an open house or a showing and you're looking around and you go, well, that's wrong and that's off and that needs repair, you start thinking, well, what else is wrong with this business? So, and then probably the biggest thing I can tell you would be to make sure that everything I just talked about with cleaning up the financials, that's actually being done. The best way is to get an audit. Have an audited financial statements.
Okay.
When I go in to do due diligence on the buy side, one of the very first questions I ask is, what kind of reliance can be placed on these financial statements? Have they been audited? Have they been reviewed, compiled, or tax return only? And if they say tax return only or compiled, I just take a big sigh, because I already know the reliability of these records are in doubt, and I need to be a little bit more skeptical of what's going on. If items have been audited, obviously I don't just rubber stamp it. We do need to look, but at least you're going in thinking, okay, well, they should have these numbers in good shape and they should have support for the transactions, third-party documents such as invoices, contracts, etc. And then along the same lines with software, QuickBooks is a very common small business software. However, it's not the most reliable because a good, sophisticated software package from an accounting perspective will not allow you to modify transactions after they've been posted. So you can post transactions, and then if you've made an error, you actually have to post either reversing entries or correcting entries. You can't just delete or overwrite. Whereas in QuickBooks, it's very fluid, malleable, and you can just, and that's where we see a lot of fraud is you'll see instances where someone will cut a check to themselves in QuickBooks. And then after the check has been printed, they'll then go back into QuickBooks and change the vendor to say American Express. So anyone who's only looking at QuickBooks without access to an audit trail, they're going to say everything looks on the up and up. So just a cautionary tale there. There's nothing wrong with QuickBooks. It's a good package. It's used. Just understand its limitations.
Sure, sure.
And then sell side due diligence. It's my understanding that this is a bit more of a European model that is trying to get more business ready. Here, we tend to say, well, here's everything we have. You figure out how much you want to pay for it and see if there's any issues and risks. There's been a trend to go do more sell side due diligence up front. I think again about buying a house, or if you're trying to sell your house, how often do you get an inspection done on your home right before you list it and fix items? Usually it's you put the house on the market, the buyer gets the inspection, and then there are surprises to you. So the advantages to doing this are it can reduce the time to close because those issues don't arise. And it just avoids the purchase price adjustments later, which is good. You want to avoid the disputes.
Sure.
Surprises.
Well, what if you have a client that says, yeah, but I'm not that big. My financial statements are fine. Should these steps, the audits, compiled, does that really cross the board for really any size company?
Well, there's clearly cost benefit considerations that need to be, if you're a very small company, an audit may not be financially feasible. But if you could do a review, the way we, or at least I personally view it, is if a compilation, which is just taking the financial information from the client and putting it into financial statement format without any assurance whatsoever, if that's worth a penny and an audit is worth $1, you can get a review, which is, we like to say, is worth about a quarter. So it's about 25% of an audit, but it's something. So I think that would go a long ways.
Got it. Thank you.
And then as far as just performing, sell side due diligence, if you don't want to get an audit or review, we have phased approaches into getting your business ready. We have pages and pages and pages of questions where we can go through and compare transactions to documents and ask questions about business practices. We don't have to do all of that. We can do the first phase or two. So, consider it kicking the tires. We, on the buy side due diligence, we have different offerings as well. We can do the kick the tires, where for $4,000 or $5,000, we just kind of 30,000 foot level, we dig a little bit, and then we'll report back in a memo format or a phone call.
Sure.
We can do more than that. We can issue reports on our due diligence findings and what our procedures were. Generally speaking, if you want a 95-page color document that's $120,000, that's probably not us. There's bigger firms who can do that. But we like to do things in phases because it's really the only way to control costs. And that's obviously a big concern of business owners. We've talked about that previously.
Sure. Great. Thank you.
All right. So, structuring a sale, I know, Lori, you can talk about this to some extent. We've talked about strategic, are there synergies? Is it a financial buyer? Management, potentially an ESOP. And there's different types of transactions that I touched on very early on. And then the next slides I have talk about a stock sale versus an asset sale. Again, I know enough to be dangerous here. The pure tax aspects of this, we usually pass on to members of our tax group, and then we work in conjunction with them, with the business owners, about what may be right for you. But this is, we've been involved in matters where one side is convinced it's going to be an asset sale and the other side is convinced it's going to be a stock sale, and they're not having that conversation. They're just flying back and forth with letters and requests and interviews and advisors. And this is, it's clearly something you need to talk about up front. So
absolutely.
But generally, an asset sale is preferred by the buyer. They get to buy the assets. They can start their depreciation over. And then generally speaking, the seller prefers a stock sale. And then another option that I just explain out there is that you can also do installment sales, which may be appealing to anyone who feels it would be beneficial to report gain over time. And it's essentially a seller financed note, if you will.
Sure. So on some of these sales, and even, you know, probably thinking back to some of the financial reporting, are there specific thresholds? Are there specific revenue thresholds, EBITDA thresholds, you know, that you say this, wherein some of these things really do kick in?
I don't exactly understand the question.
Well, and I think this is a question from one of the viewers, and I'm assuming it relates going back to the financial statements and audits. Are there those kinds of thresholds that if you have X amount of revenue, X amount of EBITDA, you really need to have or should have audited financial reporting?
I would say no.
Okay.
Usually the audit or review requirements are third-party driven. You know, say it's a banking requirement with a letter of, you know, line of credit or a loan agreement where the bank's trying to protect their loan and they want some assurance to the numbers. But there's, I would say no, generally speaking, there is not a threshold where, I mean, absent the third-party requirement to get some sort of reliability on those financial statements, it's really subjective as to whether you want to do this or not. So I think it's an internal cost benefit that you need to, and we're happy to have that conversation with you, you know, after the fact. If someone calls us up and says, hey, look, this is where we are. Do you think it would be advantageous to get an audit? Because it's not an exact science where you can plug it into a spreadsheet, say, here's revenue, here's EBITDA, here's the industry. What type of service should they get?
Sure. Got it. Okay, good. And if that did not answer your question, just let us know and we can speak further.
So I would say that will conclude my slideshow presentation. Happy to continue on the discussion with your further slides, though, Lori, obviously, and entertain any questions.
Absolutely, that's perfect. Well, and Ryan, you brought up a point, the idea of, you know, what kind of sale is it going to be and how ready is your business? The other thing to keep in mind, the more open you are to different opportunities, the higher you can drive the value of your company. You know, if you are only looking for down this small lane, that can hurt you. If you're not looking at what are the other opportunities, you may end up leaving some money on the table and that can hurt you. But you do want to be aware of all the different things that can go into it as you get your business ready. You know, we talked a little bit about industry. You know, what industry are you in and what is its future or perceived future? You know, what model of business do you have? Are you a growing business? Are you fully mature? That's a different scenario. But then we'll also, you know, look at some of the different buyer types. But when you look at a small business, and small meaning, well, that can be anywhere from, you know, a Main Street business up to even 5 to 10 million in revenue. But a small business, it is a risky financial asset, you know, and that's where a lot of the things that we were talking about are looking at those risks and working to mitigate those risks so you can increase that value. You know, your small companies are absolutely subject to business cycles and can potentially, you know, be really dramatically hit with natural disasters. So I sold the trophy and awards business in 2019. And the awards and recognition business, it's events. It's an event business. So what's happened in 2020? Yeah, events were canceled. whether they're corporate events, sporting events. So, I mean, this kind of natural disaster, if you want, it's not necessarily, if you want to call it this point in time, you know, that's affected that industry dramatically. So needless to say, I have been challenged that, boy, you were really lucky. You know, you had perfect timing. Well, it wasn't timing, it was being prepared. But that small company, it's risky. Though, you know, outside forces can really make a difference. And that's why a small company, because of those things and lacking liquidity, it can take longer to sell. So all the more reason to have your transition planning be part of your business strategy. Because when you look at valuations on companies and you look at a small business, you know, if you did a valuation on your business in 2017, that was what it was worth then. It has changed potentially, especially on the smaller business side. And there are different ways that you can have your company valued. And to be aware of that and what is the purpose of that valuation. Now, Ryan, I'm interested, when you look at the involvement of a CPA in looking at the different valuation approaches, I would imagine if somebody needs a valuation for tax purposes, that's going to be a different number than if they're going to market. Wouldn't you agree?
Yeah, it's amazing. You can come up with many different numbers on business valuations, whether it's you're preparing something for the IRS, you're preparing something for estate planning purposes, you're planning something for a potential sale, and the crazy thing is you could support all of those numbers. So it is definitely an art.
Absolutely. I would love to hear from your hat of being a CPA, just to talk a little bit about goodwill. Because when I bought my company, a lot of that purchase price, it was an asset sale, was allocated to goodwill. Share your thoughts on that.
Well, goodwill is a plug, right? You know, basically you have a purchase price and you allocate the purchase price among certain assets, and then you have this remaining piece, and it's just the amount paid above the price of the assets. And then there's different accounting and tax treatments, and as a CPA, I always find that it's a bit of a nightmare from a financial reporting perspective, testing for impairment, trying to reconcile it with how it's being reported for tax purposes. So I'm not a big fan of goodwill, let's put it that way. But if you can't tell, but that's what I would say about that at this point.
Okay, well, that's interesting. We had talked earlier, you had mentioned it, you know, the idea of transition planning and waiting, and it's not really important. I don't need to worry about it now. And that really is a common theme. You know, so many business owners, and myself included, when I was first starting running the business, it wasn't important. You know, I didn't think it was necessary. And it's one of those things that, you know, transition planning and exit planning, we can agree it's important, most definitely, but it's not urgent necessarily. And that's what we're hoping to relay, is the desire to make it a little bit more urgent. So it's part of your everyday work and it's not so last minute, so you can be ready, you know. So all of the things that Ryan was talking about and looking at is that whether you call it transition planning, exit planning, contingency planning, it's all about being ready is what it is. You know, and I don't know about you, but sometimes I do find business owners, and I'm sure I was also in that hat, in that pool, a little bit resistant to the idea of exit planning or transition planning, because you're right, that means retirement. Well, I'm not ready to do that. That's the end. And so sometimes you need to change your mindset, and maybe you change the words around it. Maybe it is contingency planning, or we really talk about using value growth principles, because all of this increases the value of your company, which helps in the end. Because the other thing you have to think about is your legacy. You know, as a business owner, even though, so I bought an existing company and I grew it and made it more profitable and sold it. And it wasn't to my kids, they weren't taking it over. I didn't have that legacy. I still had a sense of legacy and what would that mean as it related to the staff, the employees, the customers. And it's interesting as a business owner to have that, go through that thought process about legacy. And I learned that early on when I was at the closing table of buying the company in 2003. So the founding owner was next across from me, and I'm signing on the line that is dotted and all of the financial papers. I worked with the SBA, with the lender. It was at that point in time, that this founding owner got a little verklempt and was like, oh, I hadn't realized I'd be sort of emotional about this. And I did remember that, and I learned, and I had those things in the back of my head as I was working on it, because I didn't want to be surprised.
Mm-hmm. Sure.
So it's interesting, but it is really about preparation and preparing that business for that transition, because it's a process. We've talked about it. If it's next generation leaders, you know, if you do have family members that are taking it over, they need to become prepared. They may have been an employee for years and years, and they need to change their mindset and their skill set to now become a leader and owner of the company. And again, that takes time, and there's communication that's required, conversations that's required, because if you are transitioning to family, you do want it to be successful so you can continue to get together for Thanksgiving dinner. That you've had those conversations like you mentioned. But it's funny because it does come down to that different value thought, that gap that can sometimes happen. You know, somebody that thinks, well, my business is worth X because it's a great business, you know, that's what its value. Well, when you look at what is the value of a company, you can look at how Merriam-Webster defines it. You know, what is the definition of value? And you have that gray area, that middle part, the multiple. And I'm sure, you know, you've seen this where you have companies, you know, they may sell at a range of multiples, and you want to, as a seller, you want to be as up to the top of the range as possible. And those are the things you can work on now. You know, that's where you can work now on developing those good habits and developing those value drivers so you can be at the top range of that multiple.
That's right. I mean, at the end of the day, the numbers are somewhat what they are.
Right.
And the more consistent they are, the more reliable they are, the less risk that the buyer sees. Mm-hmm. The effect on purchase price really comes down to the EBITDA multiple.
Sure.
If that's how you're establishing the purchase price.
Yep. And the less risky that you can present your business as, the higher that multiple can be, because that buyer will have a little bit more peace of mind. You know, they're taking a leap of faith.
Yeah, and again, talking about expectation versus reality, we all know business owners or advisors who have talked about, you know, well, I know somebody who got 9 times EBITDA, so I know that that's what my business is worth. And there's so many variables, and if someone has already gone through that process, mm-hmm. the records have really been investigated, and it has been a thorough due diligence process, mm-hmm. and any potential risks have been identified, et cetera. And that's a very different scenario than someone who says, well, I want to sell in 5 years, so I think I'm going to get 9%. So it's just a very different stage in that process.
Mm-hmm. Absolutely. But again, the more you can work on it now and have it be part of your practice, part of your business strategy, you will be the driver of the bus, if you will.
That's right.
And the process really allows you to then ask yourself, are you ready to sell and transition? Or do you want to stay and keep growing?
Yep.
You know, as you're working on your business and planning your transition and putting in some of these key performance indicators and best practices, and you're reaping those rewards because your company is growing in value, you know, you may not be as ready to sell and transition. You may want to stay and grow, but isn't that a great place to be where
That's right.
you can answer that question and you can make that decision versus having it made for you?
No doubt about it.
Because they're, you know, those things that happen that are out of our control, we call them the 5 Ds. And it's death, disability, divorce, disagreement, and disaster. And one of those things, more than one of those things, can hit a business, and that can push a business into transition sooner than expected. And it's not necessarily when one of those 5 Ds happens to the owner. I mean, it can happen to a key employee, a key manager that maybe was when you look at your employee, somebody that was so critical and you had not captured their tribal knowledge, and all of a sudden a disability hits them or a family disaster hits them, and you as the owner have to take a step back. So those are the kinds of things to be aware of. And it's business planning. You know, the standard operating procedures documented. That was a process to work on. I'll tell you that, because, you know, the company, my company had been around since '69. There were employees that had been there since the early '80s, and they knew how to do things. You know, they knew how to do everything, and that's great. But what if they left? You know, so even though that company was small, documenting those things. So if I walked in and everybody was sick, and I still, as the owner, I still needed to make sure the doors were open and we could help customers. How did that happen? You know, it was funny. For all the years that I owned that business, I admit I never really learned how to put together a trophy, because that wasn't my strength. But we did have it documented. You know, we had all the steps documented. So a lot of the business was corporate awards, etching a piece of glass. We had worked through the process of documenting each step. So just in case, could somebody pick it up and do it? Absolutely. But that took time. You know, those kinds of things take time.
Yeah, I equate that to internal control documentation from a fraud prevention expert. It drives me crazy when owners or members of management say, "Oh, it's fine. That person's trustworthy," you know, and you say, "Well, no, the internal controls need to really be agnostic with regard to who's performing them, because they may be trustworthy. We don't know that, but they may be, but the next person may not be. And what would happen if one of those big, you know, those 5 Ds hit that individual? Then how can somebody step in and know exactly what to do without fail?"
Right, absolutely. And again, that's de-risking the business, and that might allow you to move up on that multiple range.
That's right.
And plus, it's good business practices, and it gives you peace of mind. It allows you as the owner to perhaps step out of the day-to-day, and lessen that dependency of the business on you. Yep. But all of these things, you know, do them in partnership with your advisors. Because again, you're an expert at running your business. Let other experts help you with the things that you don't know. Because sometimes we don't know what we don't know until all of a sudden we're caught, and isn't it better to have a plan and be working it so it's not so much of an emergency? At the beginning of our time together, we talked about how we want to have you walk away with some tools and resources, and we have those for you. One of the tools that we have that Ryan is providing is his time. To have time with him to ask some of those questions, some of the things that he brought up today. You may not have that kind of relationship, or it doesn't matter. Just have that conversation with Ryan. So you will receive this.
Yeah, if you need more clarity on how best to clean up your financials, if you want to understand value drivers a little bit more specifically, what can move you up that EBITDA scale, we have some proprietary information we've put together that we're happy to walk through with you.
Good. That's great. That's a huge resource. If you think your business is ready, but you're not sure you are, then I would invite you to take this assessment, which is a personal readiness to exit scoring assessment. It's quick, it's interesting. It gives you some insight on, okay, how will I get out of bed when I've sold the business? If this is all that gets me going, what do I need? Where are the gaps? Where do I need to fill in? How do I get myself ready? So you'll receive a link to learn some insights on your personal readiness to exit and things to look ahead. One of the questions is, if you had a big life event, who would you invite to it? Would it be only people that you work with? Would it be other people? Would it be a few people who you work with? Do you have a life outside of your business? And sometimes that's hard because you are in your business and it's your world. So we challenge you to take this assessment to sort of give you a little bit of a scorecard to see where you're at. Each of the earlier weeks, our trusted advisors, our experts made an offering. And if you weren't on those calls, that's fine. Those tools are still available to you. Highland Bank, Melissa Johnston, Senior VP there, she offered her time and lunch to talk to a commercial banker. So oftentimes, we don't have a banker, depending on who you bank with. They may be so big, they may not have a small business banker for you as a resource to ask some of those questions. Well, we invite you and encourage you to challenge yourself and take time and meet with a commercial banker. For community impact, we have a couple of resources from the University of Minnesota Extension and from the Community Venture Network. Communities have a lot of resources and community development resources and ways of bringing together people that are wanting to move into a small community. If you're in a community, when you close your shop because you think that's the only choice you have, that makes an impact on that community. And these folks can talk to you a little bit about, wait a second, there might be other choices out there. So we reach out to them. Our legal advisor, a couple of things. Josh gave us a checklist that you can download on some questions to gauge, is your business ready? Where is the readiness of your business? He's also, again, offering up his time to just pull another viewpoint into it and to get that legal view on things as you're planning your transition. Last week, we had Ray Carter from Sunbelt Business Advisors Midwest on, and he's offering to you a free no-cost range analysis, value range analysis. So to give you that benchmark, Ryan, you mentioned it at the very beginning, a business owner saying, I'm going to sell it for this. And your question is, have you ever had it valued? This will give you at least a value range. It's not a certified valuation, but it gives you a range. How pretty is your baby? You think it's pretty darn pretty, and it is, it's beautiful. But let's put some context around that and give yourself a range analysis. Again, so as you start bringing transition planning into the day-to-day, into the present tense, you have some benchmarks, you have some markers. Because as you've heard from Ryan today, and as I spoke also, it's a process and it takes time. So this could be a good tool for you to have that benchmark. And as you work on your business and increase its value, you can see where you saw some growth. At Vision One, again, we feel it's a process, it's strategic planning. Transition planning, exit planning, succession planning, it's all strategic planning. And it's a process. You start with identifying your goals. We're challenging you to bring on other advisors. Don't do it by yourself. Don't do it in a box. And then really learn, Ryan mentioned it. Learn about the different kinds of buyers that are out there. Learn about the different scenarios. Learn your drivers, your value drivers, and learn how to maximize them and increase your value. And then do it again. Ask yourself that question. Are you ready to transition, or do you want to keep growing? You know, maybe you keep refining and refining. You know, again, my best years ever, most profitable, best cash flow were the years I was actively engaged working on the business to get it ready to sell. And then as you move through it, as you go through the cycle, your advisors want you to be successful. They want it to be a positive experience. Ryan, any parting thoughts before and if you have questions, please post them in the chat, but any other thoughts you'd like to leave our participants with?
Well, I would just say to the business owners out there, find advisors, team up with advisors who are really passionate about what they do. It took me a long time to get to where I want to be, and the type of work I do now as a CPA, I always tell people it's as exciting as accounting can get, and I get pretty fired up about helping business owners and networking with other advisors, and I really do like to put myself in other people's shoes, and hopefully that's a characteristic that business owners will seek.
Sure. Thank you. Thank you for your time today, Ryan, and your expertise. I think you helped demystify some things, which is always a good thing for a business owner.
Well, I appreciate the opportunity. Thank you very much.
Absolutely. Brittany, any housekeeping?
No housekeeping. Just remember, we have 1 week left. Next week, we will be sending out the recording of Ryan's talk in just a couple of moments here, along with the link to be able to contact him if you have any further questions. So thank you for joining us, and enjoy the rest of your morning.
And have a great holiday weekend.
Absolutely. Bye, everyone.
Thank you. Bye.